When an entity acquires another entity, or when two parties, that is entity A and entity B, enter into a contract of which one will acquire the other, then it is required that there must be an exchange of consideration, as it is known that in every contract there must be an exchange of consideration between party A and party B. So therefore, if entity A acquires entity B, entity A must transfer an amount of consideration to the B. This consideration can be in different forms. Either the acquiring entity or the investor or the parent transfer cash, or agrees to share exchange, or may probably agree to pay the sum in a later day future, or even issue what we call loan note. Collectively, all these types of consideration that the parent or the investor is privy to is known as purchase consideration. In our group account lesson today, we want to look at how to deal with these different types of purchase consideration. So we call it purchase consideration, or sometimes we also call them the cost of investment. Remember that when you are preparing your group account, the step-by-step we looked at in our previous lesson. So if you've not watched that lesson, you can probably look at it to be at par with us. So we know that if you want to determine your goodwill, the first thing is your purchase consideration. This is the amount actually transferred by the parent to the subsidiary when an acquisition takes place, or when an investor invests in another entity which warrants control. That means they are buying more than 50% equity shares, or buying more than 50% voting right in the other entity. Then the purchase consideration, the amount transferred, can be considered to be the cost of investment or the purchase consideration. We have two sources of this amount. Either it is given to you in the additional information, or it is given to you in the statement of financial position of the parent. You will see investment in so and so subsidiary, and then the amount will be there. So in this lesson, we want to look at the varied types of the purchase consideration, because the acquiring entity is privy to several types of purchase consideration. So in this lesson, that's basically what we want to look at: the various types of purchase consideration, how to account for them, or how to treat them in the books of the group and in the books of the individual accounts, like the retained earnings and then NCI holdings. As mentioned earlier, the purchase consideration we are going to start with one of the form is cash. So cash. So either A, so let's probably use this example. A PLC is acquiring B PLC, maybe 75% of the equity shares in B PLC, and then the consideration that is being transferred from the parent to the subsidiary is cash. If that happens, then we don't have any issue. Probably you know your consideration to be in the form of cash. So if that's the case, maybe $10,000 was paid by A PLC to B PLC, then there is no issue over here. Probably you just know the amount that they have paid, or the parent or the investor has paid to acquire the subsidiary. Another form of consideration, which is the second one, so this is the first one. The second one is share exchange. We call it share exchange. This is where an entity acquires another entity by issuing shares for another shares in, or for a number of shares in the other company. So here we are saying that, assuming A PLC is acquiring B PLC by issuing 2 shares for every 3 shares in B. What it means is that they are going to issue 2 shares from the investor, and this is going to be equivalent to 3 shares in the B PLC. Anytime there is a share exchange, there is a way you should go about it to get the value that it will cost the entity to issue the shares. The value that you will establish or you will compute for becomes the cost of investment or becomes the purchase consideration. How do we do that? This is the trick. Anytime they mention that a parent or an investor is issuing a number of shares for another shares, then it's going to be like this. It's going to be 2 divided by 3. That means the parent is issuing a number of shares for another number of shares in the subsidiary. So what the parent is issuing always counts as a numerator, and what they are issuing it for in the subsidiary counts as what? As a denominator. This will multiply by the number of shares acquired by the parent. Always it will be given to you, or they will give you information for which you can use to establish that number of shares acquired. So we can say that A PLC is acquiring 75% of B PLC, and B PLC equity shares is, let's say, 100 shares. So here we can say that 70 by this will give us 75 what? Shares. So multiply by the number of shares acquired, or we can also say that A PLC acquired 75 equity shares of B PLC, of which the shareholdings of B is 100 shares. Depending on how the question is being framed, you can establish the amount of shares acquired by what? By the investor. Then this is just a number of shares. This is just the fraction that have been acquired. Then you have to multiply it with the share price. Remember that the share price here should be the parent share price. The parent share price with this one, the parent share price. Always remember. So they will provide you with the share price of the subsidiary and the share price of the parent. Remember that the share price must be that of what? The parent. So anytime there is a share exchange, this is basically how to go about it to establish the value of the share. So after getting this number, we can then, determine our purchase consideration. So in this case, what will be the treatment afterwards? Now we will determine the value. What will be the treatment after? Remember that when you are preparing the group statement of financial position, the value there becomes a share in the group. So it will become a share in the group. So you have to add it to the already existing share of the parent. That of the subsidiary has been acquired, so it will be off from the books. So this share number that we have acquired here, and the value should be added to the shareholdings of the investor or of the parent. So in this case, let's assume that the shareholdings of A PLC, which is the parent here, is $2,000. That is maybe they have acquired 2,000 shares, which is having a price of 1 cedi. So let's assume the price is 1 cedi. If that's the case, then we are saying that this divided by this will give us 25 by this will give us 50. So they have acquired $50 shares in the B PLC. That means when you're preparing your statement of financial position under the equity column, then the share capital under the group account, then the 2,000 of the parent will be added by the 50 new shares acquired. Remember that it is the shares of B that we have acquired. We have acquired all the net asset of B. So nothing of the equity shares of the subsidiary will be in the group statement of financial position. So this is how to account for a consideration that is being established by means of share exchange. Another way an entity can acquire another entity and pay or transfer consideration is by deferred payment. And most of the questions you will see 2 or 3 of the purchase considerations present. So you have to establish one, sum them together to get the purchase consideration. So here, assuming that the entity is being acquired with deferred payment, deferred payment. That's another way for which a parent or an investor can acquire another entity. From the word deferred payment means that they will buy the entity today, but the payment will be done in the future. That means they are going to buy today and you pay in the future. But with time value of money, because of time value of money, $1 today will not be $1 tomorrow. We have to unwind. We have to bring that future value we are going to pay tomorrow into today's, value before we can use it as a means of our purchase consideration. What it simply means is that, assuming that A PLC here is acquiring B PLC, the control structure is still 75%, and they agree to pay 1,000 after 2 years. After 2 years, so they agree to pay 1,000 after 2 years. So this is actually the consideration, but it's not going to be paid today. The business is being acquired today, but this amount will be received after 2 years. How do we establish or determine our purchase consideration? Now, the question will always give you the cost of capital for both the parent and the subsidiary. So let's assume that the cost of capital for the parent is 10%, while that of the subsidiary is 11%. So if that happens, you have to bring this value, which is supposed to be received by the subsidiary in 2 years' time, into today's value. So what we do here is that we have to find the present value of the future amount, which is the $1,000. So here, the amount today is going to be our 1,000, which we are going to find the present value. So we discount this by our discounting factor. The discounting factor is always 1 divided by 1 plus the cost of capital raised to the power n. This is the number of, the n is the number of years it's going to take the entity to pay back the consideration, or to pay the consideration. So here it's going to be 1 divided by 1.1 because our cost of capital here is 10. Please, here again, we use the parent cost of capital but not the subsidiary. So we use the parent cost of capital when we are dealing with the deferred payment, and also the share price of the parent when we are dealing with the share exchange. So we multiply this to get an amount. Let's assume here we are getting $700 as our discounted value. So this means that the cost of investment or the purchase consideration is going to be this 700, but not the 1,000 that is going to be paid in future or in 2 years' time. So remember that this is supposed to be raised to the power 2 years, because it will take us 2 years to pay. So if it's 1 year, we put 1 year there. If it's 3 years, we put 3 years over here. So whatever we get becomes our purchase consideration. Now, the treatment is the most important thing. Yes, this is our purchase consideration. So this is the only means for which we acquire the entity, then our total purchase consideration is this. We do the other computations to establish our goodwill, and then we can proceed to prepare our group retained account. Now, if the question is just for you to prepare statement of financial position, this will be the treatment. If the question is requiring you to prepare statement of financial position, if the question is asking to prepare statement of financial position, then in the group retained earnings, there must be an issue of unwind interest, or we call it finance cost. Finance cost. Anytime the payment is going to be deferred, then there is an issue of finance cost, or we call it unwind interest. So in this case, we have to determine our unwind interest, which is going to be an expense to us. We have to less it from the group retained earnings when the question is demanding that we prepare statement of financial position. So in this case, how do we determine our finance cost? Your finance cost in this case is going to be the cost of capital, which is the 0.1, the 10%, multiplied by the present value you have computed. So here it's going to be 700, and in this case it's going to be 70 cedis. So when you are preparing the group retained earnings, you have to less the 70 from the group retained earnings as an expense. This is the case when the question is asking us to prepare statement of financial position. Then, when you go to, this is the group retained, you have to less this as a finance cost. Then when you go to statement of financial position itself, the group statement of financial position itself, under equity, in fact, under liability, we have current liability and then what? Non-current liability. The current liability is going to be the finance cost you have computed for, and then the difference between the finance cost and the amount here. So here is going to be 930 over here. The difference between this and this one is 930. So this will be your non-current liability, whilst the finance cost you've charged for the period is going to be your current liability. Together, you will get this amount to be your total liability to be paid in 2 years' time. This is the case when the question is requiring that to prepare statement of financial position. But in the case where we are asked to prepare the income statement and other comprehensive income, then remember that we don't we treat finance costs after you've gotten your operating profit. So these finance costs will have to be less from your operating profit to get profit before tax. So this will probably be the profit before interest and tax. We less these finance costs from it to get your profit before tax. And if the question again requires that you prepare a statement of financial position together with the income statement, then the same treatment goes for the non-current liability and then the current liability. Assuming that we have acquired these assets in today, but we are going to prepare the statement, our reporting date is the second year, but not just the first year. So the second year, not just the first year. So remember that it is going to be the second year. Then this amount would have been paid at the end of the second year. This amount would have been paid because this is just the first year. Now, if you add this 70 to the amount you've gotten here, it should always give you the at the end of the period, it should always give you the total amount of 1,000 in the second year. So this is just assuming that after the acquisition, we are just doing this after 1 year. So we have acquired the business today, but just after 1 year, we are preparing an account. That is all that we've done so far. But what happens if you are preparing an account in the second year? So in the second year, by then, we would have paid this amount. So remember that it will not be a liability to us, but there will be an issue of what? The amount here, the purchase consideration will have to be unwind to the first year. Probably that would have been that year, the amount the year we will have here will be what? Will be 1. So don't be confused. So if this is the case, we've acquired the business by which we are deferring our payment for just 1 year. Then remember that after computing for your what's the name, your finance cost, if you add your finance cost to your amount you calculated here, the present value here, if you add the two, you should get the amount over here. That is it. That is what I was saying earlier, that your finance cost plus the present value should give you the amount you are supposed to pay in future. This is when it is just 1 year. But if it's 2 years, 3 years, then this has to be done in the second year. Then you add it. You add your finance cost to the liability you are owing to this one, to the present value, to get it for the next year. So in this case, if I want to compute for the finance cost for the next year, it's going to be 700 plus the 70. All these multiplied by the 0.1 will give me the finance cost for the next year. That's what I'm trying to establish over here. In the third year, whatever you calculate here will be the same thing for the subsequent year. We will take a practical questions and we will look at how it goes. Mostly, they will give you 1 year or 2 years for which you just have to. They will not give you to. You are not supposed to prepare your statement from more than 1 reporting period, so you don't have set issues like I was talking about. So just focus on what we did earlier on, and you are good to go. So another means for which an entity acquires another entity and transferring purchase consideration is by undertaking what we call deferred payment. The fourth means an entity can transfer its consideration to the subsidiary or the acquiring entity is what we call the issue of loan note. Issue of loan note. So an entity can acquire another entity by issuing what we call loan notes. Now these loan notes, the treatment is just like we did under the share exchange, and rarely do you see this in the exam situation. Okay, this one mostly don't ask questions on that. It's the first 3 that mostly you are going to be examined on under present situation. But in case it comes, probably they are going to tell you that they've issued this number of loan notes for those and so amount, as we have established the computation under the share exchange. The same thing you are going to do under the loan note. Another means for which we can also transfer our purchase consideration is what we call contingent consideration. Contingent consideration. Contingent consideration. Here, the payment of the future amount is dependent on a particular happening in the subsidiary. So, for instance, we will say that if the subsidiary is able to make a profit of, let's say, $1,000, then we will pay the consideration. This is contingent. Something must happen before we undertake or we perform an activity, and this is what we call contingent. It's supposed to be dependent on some conditions before we establish or we pay the consideration, and this also does not normally comes in the exam situation, but you are supposed to know how this works. So basically, these are the few means for which an entity can purchase another entity and use these means to pay for each consideration. Now, we are going to take about 4 different set of questions and then look at how to deal with them one after the other. Remember that the questions are a full statement, a full consolidated statement, but we will only focus on the purchase consideration aspect. And then subsequently, as we go on in our journey of group account, you'll be solving each of them one by one. So the full statement will be the link will be at the video description. Different about 4 sets full statement will be in the video description, but remember that when you are looking at it, we are only going to focus on the purchase consideration. So when we are done, our next lesson is going to be on intra-group transactions, how to eliminate intra-group non-current assets, intra-group unrealized profit on inventories and that of on a non-current asset. We will also look at goods in transit and other relevant information or activities related to intra-group transactions. So here, let's take the questions one by one and look at how to establish our purchase consideration as they are given to us in the question. So our first question is actually Institute of Chartered Accountants, Ghana exam. So that is Chartered Accountant Ghana exams. That is May 2021. That is going to be our first question, May 2021, the full set of questions. So the first part of the additional information is saying that we are looking at Staffo Group and then Bonsu, but here is a different form, the different structure of the is a different form of the consideration altogether. Here we are supposed to prepare the subsidiaries account when we have been given the group statement already. So we will look at it subsequently. We will solve this question subsequently, but here our focus is just on the purchase consideration. So we are told that Staffo purchased 80% of the 10 million ordinary shares issued at 2 series of a RIM on 1st January 2020. So this acquisition took place on 1st January 2020. So this is very important. You are supposed to determine the acquisition date and the reporting date before you start any computation. So let's go to the requirement of the question. The requirement says that you should prepare the statement on 31st December. So 31st December 2020. So this is basically 12 months from the day the entity acquired. So this is acquisition date, and then this is our reporting date. Now let's look at how the entity, which is Staffo, paid for the consideration. We were told that Staffo agreed to settle the consideration in 2 unconditional installments as follows. They agreed that they are going to pay a cash million of 33 million. So here we are using the currency, the Ghana cedi. So 33 million on, they are going to make a cash payment of 33 million on 1st January 2021. And then they will make another, this is the first one, and they will make another installment that is 30.25 on 1st January 2022. So this is the information about the purchase consideration. Information about the purchase consideration. So how do we determine the cost of the investment. They are making this cash payment, but it will be paid on this date. And this is the day we are acquiring the entity. And this is the day we are preparing what? Our statement. So the question here is we are required to prepare the income statement. So here what it means is that we are supposed to unwind this cash differently. Here the cost of capital for the business is 10%. The cost of capital here is 10%. So they're giving the cost of capital to be 10% in the question. So determination of our purchase consideration. Our purchase consideration in this case is going to be the first installment, which is the 33 million. The 33 million multiplied by 1 divided by 1.1, all raised to the power 1. Why 1? Why 1? Because from the day we acquire the business, from the first payment is going to be just 1 year. So just 1. And if you do this correctly, you are going to get an amount of, this is going to be in million, an amount of 30. And then the second payment is going to be 30.25 all multiplied by 1.1 raised to the power 2. Now from the day of the acquisition to the day of the second payment is going to be 2 years. So from 1st January to December 31st, 2020 is going to be 1 year. Okay, it's going to be 1 year. We are acquiring the thing on this date. And then the second payment, which is from 31st, remember that this date is the same as December 2020. Okay, this date is the same as December 2020. So the second payment is going to be 31st of December 2021. So that is going to be 2 years over a year. So if you do this, we are going to get an amount of 25. So our purchase consideration in this question is going to be 55 million Ghana cedis. That is going to be our purchase consideration. Remember that since this is an income statement, we have to send what's the name? We have to send a finance cost to our income statement. We are going to less it from our profit before interest and then profit before interest and tax. So how do we determine our finance cost in this case? Our finance cost in this case is going to be the amount to calculate here, which is the 30 multiplied by 0.1. This is the 10%, the cost of capital. This is going to give us 3 million. And then the second one is going to be 25 for the second payment multiplied by 0.1. And this is going to give us 2.5 million. So in all, we are going to have 5.5 million our finance cost. And this must be less from the statement of other comprehensive income. In other words, the full statement, the income statement, the profit or loss, and other comprehensive income. So we are going to less this one as our finance cost. If there's any finance cost already in the question, we add it to it and less it before from our profit before interest and tax. Now, if you go to the statement of financial position, that is under the equity side, this amount should be seen as a current liability, and then the difference between this amount and then the amount that we have borrowed, the two amounts, should give us our non-current liabilities. So that is it for the treatment of this particular question. Alright, so let's take our second question. This is also the Institute of Chartered Accountant exams for that of Ghana. This is April 2022. April 2022. Remember that this is a full question, but our focus is just going to be on the purchase consideration. So as time goes on, we'll solve all the questions together. Now, in this question, remember we are told, we are given the information on how to establish our purchase consideration. Now, one thing that I didn't establish earlier on is that anytime there is a cost, let's assume that when the entity wants to acquire another entity, they incur some costs, sometimes due diligence costs, legal fees, all those costs. If there is a cost for which the entity incurred before buying the other entity, that cost, when you are determining your purchase consideration, that cost must be less from the amount. You have to less any cost from the amount. Remember how to establish the fair value or the initial amount of a financial asset or financial liability, that is under IFRS. Now we have a video on it. If you don't have knowledge about that, you can glance through the video for the information and concepts on that particular standard. So here we are told that Stalky Limited acquired 30 million ordinary shares of Fund Limited on January 2019. So here the acquisition date is on 1st January 2019. So 1st January 2019, and then we quickly have to look at the reporting date, and which is 31st December 2020. That is acquisition date. So from, if you look at this properly, the acquisition date and the reporting date is 2 years, because from January to December 2019 is 1, and this one to 2020 is 2 years. Now we were told that the amount paid when the book value of the fund's share capital was 58 million, including share capital. So the fund has neither issued any share capital nor seen any changes in the other reserves since the acquisition of the shareholding by Stocky Limited. The recorded investment includes, so the 58 million that they have paid for the acquisition include 1.5 million due diligence cost. Due diligence cost. So this is a cost we incurred when we want to undertake the acquisition. And then we were told that the Stocky Fund Limited has no interest in Fanny's issued preferences. So this amount here has an amount of issued preferences inside, but they don't have any interest in it. Remember that acquisition of preference shares does not warrant control. If entity acquires preference shares, it doesn't warrant control. Remember, in our videos or in our lesson, I've never said acquisition of preference shares, but ordinary shares. So if an entity acquires preference shares, it doesn't what gives control to the investing entity. Here, the question is so straightforward. We've paid a cash of 58 million, by the other we incurred what? Due diligence. So here our purchase consideration is going to be our 58 million less our 1.5, which will give us 56.5. This is basically our purchase consideration because it was paid in cash. So there is no issue, as I established earlier on. If you are paying your purchase consideration in cash, there is no too much issue. So here that is basically going to be the 56.5 is going to be our purchase consideration in this particular question. So we want to again look at the next set of questions, and this is also question from Institute of Chartered Accountants, Ghana question, that is financial reporting, and this is November 2020 question. So here, remember, we are just focusing on how to determine our purchase consideration. So this is how we are going to take the lessons one by one, so that by the time we are done, we combine everything and then we will solve a full statement. With that, you will establish better understanding of the concept. So here we are told that Kingdom acquired 60% of the share of Paradise Limited on 1st April 2019. So this acquisition is being done on 1st April 2019. So immediately we have to go and look at the reporting date to see how long will it take the entity to prepare its group statement of financial position after the acquisition date. So here the requirement is saying that we are preparing this on 31st December 2019. This means that it only takes the entity 9 months from acquisition date to prepare its statement. This is where we have something we call pre-acquisition interest or pre-acquisition reserves. So we will look at it subsequently, how to account for them. Our focus is how to determine our purchase consideration. So from 1st April to 31st December 2019 is just 9 months. So everything you do you have to make sure that you take 9 months, because we were told the question has one of the clauses said that everything, all expense and income accrued evenly throughout the year. So yeah, let's read the information that will give us our purchase consideration for free. That is our focus. So that we're told that the purchase consideration was settled by share exchange. So here the purchase consideration is being done by share exchange of 2 shares in Kingdom for every 3 acquired shares in Paradise. I hope you've seen something like that. So here Kingdom is the one acquiring Paradise, and they are saying that Kingdom is issuing 2 shares for every 3 shares in Paradise. The statement contains that the share price of Kingdom is 3. So the share price here is 3 cedis per share. 3 cedis per share. That is the price of share for the parent. We are not giving the subsidiaries share, so we don't have any issue. Remember that is the parent share price that we we use over here. We were also told that in addition, Kingdom Limited will also pay cash consideration of 0.2 per share on 1st April 2020. Aside issuing shares, they are also going to pay another cash additionally. So here our purchase consideration is not just one item, but it is more than one item, as we look at in the previous questions. So in this case, how do we determine our purchase consideration? Purchase consideration. So here, remember that our figures are in CD, and we can just put 3 zeros at the top. So initially, let's look at the share exchange. Share exchange, how much is going to give us? And then we look at the other information, whether it is a deferred payment or it is on cash basis. So share exchange, they said they are issuing 3 for 2 shares for 3 shares. So this is going to be basically 2 divided by what? By 3. Now, how many shares are they acquiring? So they said they have acquired 60% share. Now you have to go to the statement of financial position and look at the shareholdings of Paradise, the subsidiary. In this case, if you look at it, they are holding 18,000 shares. 18,000 shares. So 60% of these 18,000 shares will give us 10,800. So if you multiply this by your 3, the 3 is the CD share. So here if you do this correctly, our value for the share exchange is going to be 21,600. 21,600. This is going to be the value of the share exchange. Remember that when you are preparing your statement of financial position, this one, the requirement is to prepare profit or loss. So there will be nothing like statement of financial position. But in case it should have been statement of financial position, this value would have been added to the shareholdings of the parent to form the total shareholdings of the group account. This is just one aspect. Remember, this is not our purchase consideration because there was an additional information about purchase consideration. So if you use only this one as a means of your purchase consideration, you are totally wrong. So we were told that additionally, Kingdom Limited will also pay a cash consideration of 0.2. So they are going to pay 0.25 Ghana cedis in this case. On which date? They are going to pay this on 1st April. So they are going to make this payment 0.275 on 1st April 2020. So look at when we are acquiring the business and look at where they are paying this. So this means that from here to this place is going to be 1 year. So they are making this payment not on the same day, but they are going to make the payment after 1 year. So this gives you the information that this is what a deferred consideration. This is a deferred consideration. So in this case, our deferred consideration is going to be the amount we don't know. So they said, listen to this very well. Sometimes they will make share exchange of part of the shares acquired, and then the remaining shares will be the one that they are going to pay for in future. But in this case, we were told that for each share acquired in Paradise, that means all the shares acquired is what we are going to make this computation on. But in some questions, they will tell you that after the share exchange is for this particular number of shares, and then the remaining was done through this. But here, all the shares had an effect on this one. So in this case, it's going to be the 0.275 multiplied by the total number of shares acquired of 10,800 shares. So after this, we multiply it by our 1 divided by 1, which is the cost of capital for the businesses. 10% in this case as well. So the cost of capital is 10% for the parent. You are not given the cost of capital for the subsidiary, so you don't have any issue. So multiply by 1.1 or raise the power 1 because it will take 1 year to pay, and this will give us 2,700. 2,000. If you do this, you get 2,700. So we add these two together to get 24,300. So please, this is going to be your purchase consideration to be used in the question. 24,300 Ghana cedis. Remember, there is 3 zeros at the top, so it will be 24.3 million Ghana cedis to be used as your purchase consideration. So now the treatment is, how do we subsequently account for this deferred payment? You know that the deferred payment is supposed to be treated as what? You are supposed to calculate your finance cost on it. So your finance cost in this case, how do we determine the finance cost? The finance cost in this case is going to be the 2,700 multiplied by 0.1 multiplied by since it's going to take us just 9 months to prepare the account, you have to multiply this by 9 divided by 12 before you can get our purchase consideration. Our finance cost. In this case, the question asks us to prepare income statements or profit or loss and other comprehensive income. So we are going to charge the finance cost in the profit or loss account. We are going to less it from the profit before interest and then tax, or the operating profit, to get our profit before tax. So in this question as well, this is the treatment, and you can see that every question has a way to establish what the purchase consideration. So the most important thing is understanding the whole concept, so that anytime the question falls to you, you can easily solve it. So we will probably look at our last question and to see how we can establish the purchase consideration. Right, so this question too is Institute of Chartered Accountants Ghana question, that is November 2021, and then we're told that on 1st November 2019, Sankofa purchased 2.4 million ordinary shares of K3. So here the acquisition date. So here the acquisition date is on 1st November 2019. Now quickly let's look at the reporting date. So the reporting date in this question is going to be 31st December 2021. Now let's see, 1st November 2018 to 31st December 2019 is 1 year. 2019 in the next year is 1 year. 2020 is 2 years, and 2021. So 2019 December 2019, is it December? October rather, sorry. So 31st October. Right, so 2019 October is 1 year. 2020 October is 2 years. So 2020 is 2 years. 2021 October is 3 years. So from the date of acquisition to the date of preparing our statement of financial position is 3 years. 3 years. It will take us 3 years before we will prepare. Acquisition date is this, reporting date is this one. Now let's look at the information pertaining to our purchase consideration. So in the question, we were told that the retained earnings on the date, the acquisition retained earnings is 11 million, and there have been no movement in the share as of that. Now they said as part of the consideration given for the shares acquired, the shareholders of Catchy accepted 1 million shares worth 7 million in Sankofa at acquisition. So as part of the acquisition, the shareholders of the subsidiary, which is the K3, has accepted 1 million shares. So please, we've acquired 2.4 million shares in this case. We are not determining the control structure. It would have been 2.4 million shares divided by the total number of shares capitalized by the parent, and I think this is 8 million. So it would have given us what? Our control. Now here in the question, our focus is how to determine the purchase consideration in this question. Purchase consideration. So we were told that the first one was share issue, and they have agreed to issue 1 million of the shares, 1 million shares for an amount of 7 million. So 1 million. So this is not, as we've been seeing, 2 shares for every 3 shares, but this one is straightforward. They have issued 1 million shares, and they have given us what the price of this 1 million share is. What is 7? The value is 7 million. As simple as that. So they have issued 1 million shares worth 7 million in Sankofa at acquisition. Now this is down the total, because if they have issued 1 million shares for 7 million, then they acquired 2.4 million shares. Then there is an existing of what? 4 million shares, which has not, we don't have any information about yet. Now let's see if there is any information about it. They said the remaining consideration was agreed to be paid on 31st October for 12.1 million. So the remaining consideration was agreed to be paid. So the remaining consideration was agreed to be paid on 31st October, the date of our consideration, on October 31st October 2020. 31st October 2020. Now, for an agreed amount of 12.1 million Ghana cedis. So they are going to make the payment of this amount on October 20th, 2020 for 12.1 million Ghana cedis. This question is very, very good because it brings dynamics in everything they are doing. Now listen, the date you are preparing the account and the date this payment is made, that means you have made the payment already before even you are preparing our account. So how many years did it take us to make this payment? So 1st November 2019, 1st November 2018 to 31st October 2019 is 1 year, and then to the 31st October 2020 is 2 years. So it's taking us 2 years to make this payment. So in this case, it's going to be our deferred consideration is going to be the 12.1 million multiplied by, we have the cost of capital, yes, it's 10%, so it's going to be 1 divided by 1.1 all raised to the power 2 multiplied by, so this is going to give us 10 million. So we sum up these two to get our 17 million. Remember, this is just to help us in determining our goodwill, because the first item that comes when we are determining our goodwill is what is our purchase consideration. Now remember that this money has already been paid. Why am I saying that? If you look at the question has a clause there that entries have been correctly passed for the effect of all the above. All these information that entries have been done, they have accounted for the finance cost, how this will be done in the statement of financial position, everything has been done, including any unwind discount. So the finance cost I just talked about, except for the final payment made on 31st October 2020. Only that amount has not been recorded. So that amount is actually cash going out, and it's a finance cost. It doesn't affect any of our accounts, just as the cash that we just take consideration. We just take the purchase consideration as our cash. The same thing that was done in 2020, the payment. That is the only thing they didn't account for. Aside everything, the finance cost, everything has been taken into consideration already. So you don't need to go and do any finance cost or anything in this question. So please take notice. Look at what the question is saying. The clause, the date, everything is important. So this is basically about what? Purchase consideration. In our subsequent lesson on group account and consolidation, we are going to look at intra-group transactions, and we also look at newly acquired assets, or asset that the subsidiary does not recognize as an asset, but from acquisition the parent will recognize such an item also as an asset. And then we also look at other relevant information that will help you to prepare a very good and excellent group account and consolidation. Thank you. Remember to leave any question or any suggestion at the comment section, and we will readily attend to it. Thank you for being part of the learning family. Still RONAS, comprehending the complications.